Hey guys, welcome back to The Bite. Michael Sema here, Nick Baranowski, and today's topic is top 5 myths about your credit scores and how to apply for a mortgage when it comes to using your credit report. Ooh. So myth number 1, checking your own credit report is going to affect your credit scores.
Yeah.
False. Definitely false. You're allowed to check your credit whenever you want, and it's not going to affect your FICO score by dropping it. And a lot of Americans haven't checked their credit. There's a new study that just came out that talked about that 52% of Americans haven't even looked at their own credit report in the past year. It's an alarming rate, especially when it comes to starting the process of possibly shopping for a home and getting a mortgage. You want to know where your credit scores are, and it's okay to check it yourself. It's not going to hurt you in any type of way. So take a look at one of the credit bureaus or some of these online websites and see where your credit score is, just in case you need to do something to improve it before you start the process.
Yeah, it's important to know where you stand so that you can know where you're going to be going when it comes to lending. If you have a fear of checking your credit score because you think it's going to hurt it, how are you going to ever know what's on there that you can prepare or clean up or figure out prior to actually applying for that loan or mortgage?
Myth number 2.
Myth number 2, I pay all my bills on time, so my credit should be perfect.
Oof.
This one is more about understanding the percent, what goes into your actual credit score. So there's a variety of factors, and it's important to say that yes, paying your bills on time represents 35% of your credit score, but only 35%. So you can make all your payments on time, every single month, and you could still have trouble or have a lower credit score than you know. So the next most important thing that I always share with clients is 30% of your credit score is how you use the credit that you're being given. So most people don't realize that the credit cards and things that they have going, they could run up balances and they're like, oh, okay, I'm making the payment, so it's fine, everything is good. The problem is that if you're using more than 30% of your credit limits on any accounts, it actually hurts your score. And 30% I think is actually a pretty high number. I like to say that people should be using less than 20%. What do I mean by this? This means saying if someone gives you a $5,000 credit line on a credit card, credit limit, that you're using less than $2,000 as a balance on that credit card. So basically what it's saying is that you should be using your credit cards or open accounts, but not carrying balances that are higher than 20 or 30% because it's going to really affect your score negatively. Another 15% is the length of credit history. This is another important one because how long you've had accounts open really benefits your score. So a lot of people believe that if you close out accounts, it's actually going to bring up your score, and that's actually not true. It's better to leave accounts open even if you don't use them because of that history, and that's 15% of your score. So
keep them at a zero balance.
Yeah, and just keep them, use them every once in a while or keep them as a backup. That's always a better way to go. So myth number 2, paying your bills on time is not the only way to ensure a high credit score.
And there's good debt and bad negative revolving debt. Credit card debt, if it is maxed out over that 30% mark, will affect your credit scores. But student debt, car loans, mortgages, those are all positive. Even though they might be maxed out compared to the total amount that they gave you, it won't affect your score as much as a higher balance credit card would.
Yeah,
so,
it's the open lines, like revolving lines of credit, like credit cards that really I see has the biggest impact on credit scores today. And simply from one month to another, someone can have a 20, 30 point swing just because of how they paid their credit card balance in the previous month. So this one is a big one for me, and I see it all the time. So keep your credit card balances, I like to say, below 20%. If you have them above 30%, they're really going to start affecting your credit score negatively. And if they're maxed out, your score is going to suffer. Myth number 3, you only have one credit score. This one is a myth that people think that if they have a score that they found on one website, that's going to be the score that's used everywhere. And this is actually false, because there's actually hundreds of different scoring models out there. And depending on the purpose for your inquiry, like if you're applying for a mortgage or a car or a credit card, different scoring models are used. So the same credit score that you see on one place might not be the same for another. And this is, confusing a little bit, but it's important to know that when you're applying for a mortgage, we use a specific version of FICO score from each of the bureaus data, and the middle score that comes up is the one that's used for lending. So it's a myth to say that just because you checked your score one time in one place, that's your credit score and that's what everybody's going to have.
So it's false. So myth number 4, you need perfect credit to get approved for a mortgage. Definitely false. There's programs out there designed specifically for individuals that don't have stellar credit. And it's okay to not be into the 800s or 700s. These programs are designed with low down payment programs and extremely competitive interest rates as well. So the best thing to do is just talk to a home loan expert, see exactly what programs they have to offer, or just reach out to us directly and we'll let you know exactly what you specifically could qualify for.
Myth number 5. This one we see a lot with people applying with someone else. My significant other or partner has a excellent credit score, so we should be good.
Yeah.
This one is a lot of times people think that they can hang on whoever they're applying with and their credit report and history. And the reason why this is false is that we take everyone on the application's credit score into account. And when it comes to more than one borrower on the loan, we actually take the lower. So it's important to know where you stand and realize that, hey, you're just as important as someone with the higher credit that you're applying with, because both are taken into consideration. So it's important to see where you're at with that.
Yeah, and it goes back to myth number 1, is just making sure you check your credit.
Yeah.
Look into it. See exactly what you could do to improve it and get it into where you need to get it into to qualify for the best programs out there.
Yeah.
But those are the top 5 myths. If you guys have any additional questions, please feel free. You could always reach out to us. And I guess we'll see you on the next video. Take care.